So you may remember this chart, and I would point to right here that this is for February. This is last month's chart, and I want you to see this is where we were last year, or last month, I'm sorry. And you'll note that as I was talking to you, I made comment again that in December we had a new high, and we did in January, and we even did in February. And so there was all kinds of feeling that, okay, even though things feel a little bit awkward or uncomfortable, obviously the markets aren't really having a problem with it at any detail yet. But we come forward to March, and I just simply put the same chart up, but now you may notice that this activity has changed significantly, and it's broken down through the 200-day moving average. Again, I'll back up, you can see it there, and now you can see what another month has done. And this behavior from the 19th is a big deal. It's a very big deal because it's a lot of volume and it's a lot of velocity on the way down, and that's concerning. Is it the end? I'm not suggesting that right now. I'm not trying to scare you. I'm just telling you what we're seeing and then trying to talk through with you how we're going to be handling things and give you some ideas what we're doing next, and that should give you some ability to have some questions for us and maybe some ideas on how you might like us to handle some things for your account. But I want you to know that we see it and we're on top of it. So let's talk about this in a little more detail. When we take a look at that breakdown, what we see here is, first of all, this red line here is the 200-day moving average. And the 200-day moving average is critical. Long before there was all of these computer programs and the applications and all this information that exists, the old timers, they would use the 200-day moving average as a demarcation line. And simply put, it would be this simple question. If we're above the 200-day moving average, meaning the market activity is above the 200-day moving average, why aren't we invested? And if we're below the 200-day moving average, the question would be, why are we invested? And that really is a big question. And what happened just on Friday was we broke right through the 200-day moving average. Now, I'll show you in a little bit. It's happened plenty of times before, but with that, there's some behavior over the next 2 to 4 weeks that will determine what we need to do next. And that's really what the big important piece is. It's not that we broke through the 200-day moving average and it's all over. It's more that because we did it, we have to start thinking carefully about what our next steps are going to be. So we broke through the 200-day moving average, broke through the 20, the 50, then through the 200, and I'm going to show you in a little more detail. This was February 19th when we're at the top. This was last Friday when we broke through it, and as of yesterday and today, Tuesday, we've gone even further below that number. So we're going to take a look at that as well. Looking at it a little longer detail, we can see how the markets have hit these new highs, but we can also see, again, this is February, how the market had broken some of the barriers of the 20-day moving average, the 50-day moving average, and again, if we bring it to March now, we can see how it broke through the 200-day moving average and the concerns that brings about, along with the fact that there's even a little more volume here for that. So what are the equities markets telling us today? Well, let's, instead of looking at these charts, let's go ahead and look at a version of that chart. And as you can tell, make this a little bit bigger so you can see it. As you can tell, we have broken well below it. Certainly yesterday was a day of panic selling. And today, while it wasn't quite as bad, it did panic sell some more today. But it actually, if you take a look at the daily activity, it turned down for a while and then actually turned back up towards the end of the day, which is a good sign. What does this mean though? Well, what this means, and here's sort of the most important piece to this, is that what we're looking for now is what you'd call a bottom. Meaning that we're looking for a place where the market stops. It doesn't just go all the way down. It never does that. We're looking for a place where it stops, and then what will happen is it will begin to turn back up again. And I'm going to show you what that looks like from some past experience. But if I make this a little bit smaller again, there you go, a little bigger, I'm sorry, you can see that what we're doing right now is we are actually comparing to behavior back in August of 2022. You may remember that we had a big drop in the markets in August of 2022. As a matter of fact, not August, of the year 2022. And so, let me see here. Oh, that's 24, sorry. So we're looking at 24. I'm going to go back further to 22 when I end this slide. So we hit this area right here, which is sort of a floor of support. We broke through it. So now we're looking to see, is it going to go further down or is it going to turn around and head back up? To that point, here's that example as well. Broke down, almost got down to the 200-day moving average and turned around and headed back up, and then had another pullback, another V-shaped recovery, turned around and headed back up. And so the question becomes, what do we do with this next? So let's take this and break this out a little bit further for you. So this is the S&P 500, which means the 500 largest companies in America broken up by the 11 different industries, and it's set out to kind of give us a comparison on what's going on and how that works. And you may see we've gone all the way back to 2000 on this chart. And the reason we've gone this far back is because I'm trying to illustrate here how this has worked over time, how during 2008 to 2009 and 10, 11, on up to 12, how it functioned, came back. Same thing true with 2001, how it took a big hit, how it worked its way back up, and how these pieces fit together in relationship to today. Now you can see up here, this is a little tiny drop compared to what these two drops are. And I mentioned 2022 a moment ago. Here's the pandemic. This is 2020 when the pandemic happened. That was a very short, it went down and then came right back, had a very nice V-shaped recovery. Here's 22, what I was mentioning before, how 22 had a downturn. As a matter of fact, if I put up here, 22 had a downturn. It's hard for you to see it unless you look over here to the left side of the screen next to the bar. It's down 23.4% by the time it hits the low in 2022. So 23%, $100,000 means that your account is now down to $77,000. And that's pretty uncomfortable for people. And so that's what we're looking at there. Let's take a look if we identify, for instance, the same kind of thinking for the 2008 downturn. Again, if you look over to the bottom of the screen, you can see, you'll notice there, it says 52.98%, 52.9% down for the market at that time. And if we go to 2001 and look at that downturn, that was 48.8%, 48.3%. Now, again, to put those in dollar amounts, if it's down 50%, you have $100,000, it's down to $50,000. Most people don't have the constitution for that. And so consequently, we are watching very carefully on this behavior and then what to do next with it. That's a big part of what we do when we're trying to manage portfolios. It is definitely art and science, trying to put together the science pieces of it and match the opportunities to take advantage of those for clients, and then figure out how to protect money against downturns and how to take advantage of opportunities when they show themselves. So when I tell you that I think the supports are out there that say this is going to get worse, not better, there's several reasons fundamentally I think that. And some of it is taking a look here at the sort of key indexes that we work off of. The Dow Jones 65, the Dow Jones Transportation, the Utility Average, the Russell 2000, the S&P 500 cyclical sector, S&P equal weighted, the New York Stock Exchange daily advanced decline line. Every one of these, you'll note, is negative from November. They had downturns in every one of them, except for the S&P financials, which have actually held their own until just recently. And so the question, and if all of them are down, that would say one thing, but when most of them are down, that certainly says something. But the fact financials are up has been interesting, and we think it's connected maybe to the fact that banking regulations are being worked upon and maybe even adjusted and made more beneficial for consumers and for banks. Also, the tax cut that Trump is talking about, that also seems to have a lot of impact in making bank financials with investment firms and banks and I keep saying banks, I should say investment firms, insurance companies, banking, family wealth offices, etc. This may have a big impact in making it so those firms will have some opportunities that by itself is helping hold the S&P financials up. So looking at this, when we look at what the equities markets are telling us today, it looks questionable, but it doesn't look like it's all over yet, but it really does have a very awkward feeling, a very uncomfortable feeling with that. Now, let me hit a couple of points here first. So as I told you before, we have a number of resources that we follow, that we utilize their information to make decisions on. People that have access to information I couldn't get, people that have resources outside of where we would normally go, people that aren't even connected with any of our companies. We pay for resources because we want to know what's going on. What I'm going to tell you is this. Remember I mentioned fundamental and technical analytics. All of the fundamental analysts are really scratching their heads and saying it's not that bad yet, but we see how it could go bad. All the technical analytics, all those people, or the majority of them, are concerned that this could be another 2008. So on one hand, I've got the fundamentalists telling me, I think this is not terrible, it's going to work out, but it could be a problem. And we got the technical people all saying, oh, we got to be really careful here over the next 30 days because it could look like 2008 again. I don't know which one it is, and I wish I did. If I did, obviously, we're making a lot of decisions right now. So what we do is, instead of trying to be predicting, a prognosticator on what's happening, we try to make sense of everything that's happening and then put in place the best decisions, being patient and then reacting appropriately to what's going on. So to that point, let me just share something with you here. This chart here shows that 25 times since 2007, I believe here, 25 times 25 times the S&P has hit the 200-day moving average, this red line, and bounced off and took off again. 25 times it's done that. It might have broken through a little bit and then took off again. 5 of those times it broke through the 200-day moving average and it declined 10% or more, which 10% represents a correction, 20% represents a bear market. 5 times it was bad, 25 times it was good. So in our favor, we have a lot of opportunity that this is not the end of the world. That's why the reaction I'm having is not to be afraid, but rather to recognize there's a lot of moving parts out here that could change this. But I would also say that if you look at this long-term market, what you see here is this is 2009. Here we are to 2025. That's a long time without a reset. And that market decline of 20, 30, 40, or even 50% could be exactly the reset that's sitting out there. We've known that something like this would come sooner or later. It's obvious. But we didn't know when and we don't know where. And when I was sharing with you the information about how all the recession information seemed to have disappeared after the election for the next 2 or 3 months seemed to be completely off the table. At the same time, when it came roaring back, which it did starting February 19th, became this new decision that, wow, we've got to make sure this is not going to be a problem.